Hello, everyone, and welcome back to South Bank Live. We're on episode 26 to bring in the new year, 2022. Hope you're having a great 2022 so far. My name is Boaz Shoshan, and I'm joined, as ever, by John Butler. John, you have a good Hogmanay?
Uh, yes, indeed, and Happy New Year to you.
Thanks, John. It was very good over here, I must say. In the aftermath of Hogmanay, I did actually catch COVID. Finally, it was something of an inevitability of it. I'm pretty surprised I lasted this far without catching COVID, considering all the pubs I've been to since March 2020. But it was fitting that it had to be Hogmanay, I suppose. But yeah, no problems there for me. Has been a very interesting start to the year. And indeed, I'm sure it shall continue to be, which will continue in South Bank Live, as we shall be continuing this. We'll try to do this every week as we go through the year. Thank you to everybody who has tuned in with us this evening. It is great to be back. It does feel like it was quite a while since I was sipping eggnog in our last episode of South Bank Live. But here we are once again to discuss the big themes of the week. Now, John, to start us off this week, I thought we should go straight to, a nice insider trading scandal. I mean, there's nothing like a good insider trading scandal, is there? Especially when it involves public officials. It's always a nice gossipy twist to add on top of a bit of the old, fraudulent disclosures and sneaking around when it comes to making investments. And this, of course, happens. This is surrounding the Fed. If we take a look at some of the headlines that we've seen this week, there were a couple I thought we could take a quick look at. I think the first one was, from Yahoo News. Fed's Richard Clarida to leave the vice chair position 2 weeks early. And there was another one saying how the Washington, D.C. has an insider trading problem. Though, of course, in this case, we're looking just at the Fed itself. Though, of course, Washington, D.C., as we shall continue to explore, has a very interesting insider trading problem as well. But yeah, just going back to the Fed and going back to Clarida, who has been a very strong, very prominent member of the Federal Reserve. I find it very interesting that suddenly it's seen as a big taboo that Fed chairs, Federal Reserve governors have been making trades, when they know privileged information about where interest rates and quantitative easing are going. And I was interested to know if you could shed some light on why now. Why is it that central bankers are getting in trouble for doing this when they've been getting away with it for so long?
Well, look, I mean, there's two explanations and maybe variations between those two. One is that once upon a time, people would have just said, look, the Fed is only making incremental changes, incremental decisions at the macro level. It's impossible to know how and to what extent they might affect specific firms. And and as a result, there's no way you can draw some obvious, cost benefit causal link to bring to a proper legal procedure and process and find someone guilty of abusing insider knowledge. However, and this is the thing, look, let's face it, right? Ever since 2008, when the Fed started to arguably, on occasion, although they'll deny this to this day, but depending on who you ask, beginning in 2008, they began arguably to violate the Federal Reserve Act, which is what circumscribes the powers of the Fed and what it's allowed to do and how it's allowed to make decisions. And so ever since, the Fed has placed itself under a hell of a lot more scrutiny. And you may recall that, various media organizations, Bloomberg, the Wall Street Journal, a handful of other less well-known ones, have written exposés post 2008, 2009, when a lot of extraordinary, arguably illegal actions took place, to show that decisions were made in ways that were so arbitrary and were arguably known to insiders and this and that and the other thing. And loads of stuff came out. And then things went quiet after that. But the genie was sort of let out of the bottle that Fed officials now made decisions post 2008, now made decisions that were unbelievably market relevant to the point where a specific firm could live or die practically based on that decision. So fast forward to today, and this is where the second explanation comes in, which is that the Fed continues to operate in a way which is unbelievably market relevant, much more market relevant than the Federal Reserve Act would imply regarding the powers it's supposed to have and how it's supposed to exercise those. And for an insider, Vice Chairman Clarida in this case, to have now demonstrably transacted immediately prior. I mean, right, I think it was 2 days before in one case,
Yeah.
the release of a big decision where arguably he kind of knew what was going to happen. That just looks bad, right? So not only do you have the context of the Fed already having lost a lot of credibility in this regard and opened itself up to accusations of corruption, but now you have an instance of a very senior Fed official acting imminently prior to an imminent release of a decision that he probably knew about. It just looks awful. And yes, he's resigning. Disgrace is a strong word, but that's kind of the one that comes to mind here.
I mean, if it's 2 weeks early, he just needed to wait 2 weeks, and then he would have been out. He would have been finished with his position. It does make it look quite bad that he is leaving. But John, do you think this marks a change in the public's perception of central bankers? Because interestingly, over the past few years, we have seen something of a lionization of central banks. Post-crisis, there was the whole Occupy Wall Street thing, which of course made central banks look very bad. But then after, in this intervening period, during the mid-2010s all the way through to now, and there was some really extreme stuff with Canada and with some Canadian press coverage of Mark Carney, I remember, which was really treating him as greater even than a celebrity. I mean, they refer to him almost as some kind of deity. Does this mark a turning point? Do you think we're going to see much more sort of attacks on central bankers in general? Or do you think this is just an isolated incident? Because in this case, Clarida just went way over the line.
Look, we've been on this road for a long time, although to be fair, the section of road we're traveling over now is arguably different, and yet it still kind of follows logically. So let's rewind a bit. Back in the 60s, when McChesney Martin was the chairman of the Fed, nobody knew who he was. I mean, they couldn't pronounce his name properly because it's a bit of an odd name, whatever, right? Unless you're Irish, I don't know. Okay. So, I mean, nobody knew who the Fed chairman was. And then you go through the stagflationary 1970s, well, especially the late 1970s and early 1980s, and Paul Volcker arrives on the scene. And oddly enough, he becomes not famous, but infamous for raising interest rates to levels that had not been seen ever since the Fed had been created. And that's a big deal. So here we're going back, decades and decades. And all of a sudden, it's the first time in history when nobody could disagree the Fed deliberately caused a recession. Now, they had reasons to do so, and Volcker, to his dying day, defended those reasons to do so. But he would admit, of course we caused a recession. We had no other choice. We had to get inflation under control. It was the only way to do it. So Volcker becomes infamous at first and only famous in a more positive sense in hindsight for having tamed the inflation beast and restored some balance to the U.S. economy, inherited by Alan Greenspan, who subsequently becomes the first rock star there ever was. Before there was Carney, Greenspan was already a bit of a rock star central banker. And Greenspan, I'm not sure it ever became a household name, but it got close. And then Carney and Bernanke and a handful of others arrive on the scene going into and coming out of the crisis. And they remain rock stars. And that's the real odd part, right? These guys who, went into and went through this crisis are still seen as the paragons of central bank monetary virtue. That starts to become a bit questionable. And so clearly there was a change in the public perception around that time. And then you come through to today. And to think that, these now not paragon of virtue central bankers might be double dealing on the side in ways that exploit their insider positions. I mean, that's kind of beyond the pale. And so I can see, Clarida may claim he's just, unlucky, wrong place, wrong time, did the same thing everyone else used to do. And maybe that's true that everyone else used to do it. but no one else would have cared or noticed because all that other baggage wasn't being carried until more recently.
Yeah, it does feel like you can get away with that kind of thing when the going is good,
Yeah,
but
exactly.
now
Exactly
it's
right.
not really quite the same time. It's just not the same playing field, I guess, as it used to be.
No.
We do have we do have quite a few people watching. Good evening to all of you just recently tuned in. Alexander in the chat says hi, hello there, Alexander. Hope you're having a good evening. We may have maybe a little muted at the start of this year as everybody is sort of shaking off the hangover from Hogmanay, perhaps. Though it is a fair bit into January now. You don't have too much of an excuse where that is concerned. One thing I wanted to continue with, John, on this note of insider trading and sort of this sort of rotten sense of rotten financial public crossover where you've got public officials dealing on the side was this very interesting image that became very big on Twitter, and indeed it was retweeted by Jack Dorsey, which I thought was quite interesting. And this is just a scorecard, as it were, for congressmen in the US who have beaten the S&P 500 in terms of their returns. So I think we can get that on the screen. It's so because Congress people have to disclose publicly when they make trades, it is possible to just mark their performance. And so here we have on this table here, we've got a list of various Congress people with the S&P at the bottom, and the entire list is Congress people that managed to beat the S&P 500. And of course, with Republicans marked in red and Democrats in blue. Now, John, I mean, looking at this, Joe Biden's in power. Surely it should be the Democrats who are making the best gains from being in power. And yet we have got Austin Scott, who is top of the list. Brian Mast, French Hill, John Curtis, and Dan Crenshaw are the top outperformers of the S&P in 2021, and they're all Republicans. And I must say, to my great shame, I don't even know. I've never heard of Austin Scott, and yet, what is he doing in politics? He clearly should be managing money when he's making such incredible returns over and above the benchmark. And indeed, I was surprised to see that Dan Crenshaw has beaten Nancy Pelosi when it comes to beating the S&P 500, as she has such a reputation now for beating the market. A very good, very interesting graphic there. I believe Jack Dorsey was retweeting it as he was making he was saying it's a red flag when politicians are making so much money, and indeed when they're beating the investment benchmark, which we're all supposed to be chasing through passive investment vehicles. So we can just go back to our regular screen now, but. Yeah, I mean, why is Austin Scott in power, John? He should be managing money. Clearly, he's got great investing acumen. What's he doing in politics?
Well, maybe he won't be for long. Who knows? I mean, he clearly has a more lucrative career ahead of him at this rate. Although, if it is true, and it's a big if, he's realizing these returns because of insider knowledge of pending legislation, which is what this is about. Then no, I guess if he does leave Congress, he'll lose his edge. But look, I don't know. I just don't know. That said, look, that graphic, while it does say something interesting, but it doesn't tell us the whole picture because, of course, it's truncated at the S&P itself. There are over 400 serving members of Congress, and so we're seeing only the ones who happen to be shown here outperforming the S&P. There could be a long tail that underperform the S&P, and we're not seeing that. So it's possible that some Congress people do very poorly. But, and this is the big but, two things. First, it is a curiosity that the United States has arguably the strictest insider trading rules, prohibitions, in the developed world of any country. There are some countries like France that have essentially none. They just figure, look, if information's going to leak around, it leaks around, and that's just the way business is done. We're not going to bother trying to police that. Whereas in the US, it's a big deal. And occasionally someone very prominent, I mean, Martha Stewart, if anyone recalls that name, goes to jail for insider trading,
right? Yep.
Even if they don't really make much money. The fact that you simply do it is bad enough. So, okay, fine. But it is a curiosity that sitting members of the U.S. Congress who are reviewing pending legislation having to do with how to tax, how to subsidize, or otherwise harm or help specific industries, which by implication means specific firms, are allowed to trade on that information. It's look, nobody understands why, other than pure politics, that Congress won't vote away its own privilege to make money off of that sort of information. And it's a hugely cynical thing to say, but I don't know how else to explain it. That's just the way it is. That's the first comment I'll make. The second is this: of all the Democrats, guess who's top of the pile? The one who is in the best position to be allowed and able to review every piece of pending legislation, standing in every committee of the House of Representatives. And if she reaches across to the other house, the Senate too. Nancy Pelosi, Speaker of the House. Look, if you're a member of the Defense Committee, fine. You'll be reviewing pending defense legislation, which will have to do with which defense firms will get which contracts for which big projects and how much profit that implies. Okay, but what if you're on the committee that has to do with public health and approval of big pharma and what they're up to and what the government subsidizes? And if you're on one committee, fine. You can review that committee's docs, but you can't grab them from another committee. Pelosi sees it all, and she's top of the Democrat table. That tells you something.
It does, but it does beg the question, John. Why is it the Republicans are top of the pops here if they're not in power?
Again, this goes back to my first comment. The fact is, we're seeing a truncated distribution here, right? And there might well be an equal number of Republicans who are the other end of the scale. Maybe Republicans just punt around more. Some get lucky, some get unlucky.
Yeah, a bit more adventurous, maybe.
Maybe.
I did see there was a proposal to actually get to launch an ETF that just follows Nancy Pelosi's, when she discloses that she's buying calls or whatever, just to follow that. It would be very funny if that did happen.
I mean, how could you stop it? I mean, it's public information. Why should anyone be prohibited from creating an algorithm? I mean, to broaden the term of what an algorithm is, that does nothing but follow her trades the moment they're disclosed and maybe allocates in a way which is just evenly weighted and rebalances on a quarterly or annual basis. It would be difficult to make that illegal. It's public info. Anyway.
Yeah, indeed. And of course, you can just make an index of that. So if you can make an index, why not make a product? It is funny to see this thing happening. I must, the politics of it all is, and some of the insider information that they may have been able to have, and of course the characters that get wound up in it all. It's very, very fascinating to watch. I actually have one other question. We're now hearing some rumblings from the Republican side saying, it should be illegal for any member of Congress to hold stocks and things like that. And this sounds to me much more like, it's just Republicans are out of power, so they're making noises to appeal to the public and get some of that. Is there any possibility, do you think, of that happening, John?
Look, there are elements of the U.S. government, and this includes the presidency, where you're required to place all of your liquid investable assets into a so-called blind trust, where you can give a trustee a mandate, instructions regarding more or less how you want it to be invested, following some sort of investment process, which could be quite detailed and who knows what how high frequency or whatever. But blind is blind. And the idea is that once you hand it over, and you can't touch the thing until after you have left office. And indeed, in some cases, until a full year after you've left office, such that there's no way you could interfere with it even immediately after you step down, trying to capitalize on whatever your most recent decisions might have been. It does surprise some people that is not just a blanket regulation for anyone in a position to review pending legislation, pending regulation, or any other federally, or for that matter, even at the state level, especially if you're talking about big states where they're home to huge companies. It shocks some people that is not just a blanket requirement.
Yep.
And it's sort of an odd historical legacy that it exists at all, having to do with aspects of the separation of powers in the United States, don't which wouldn't have been relevant to the founders of the country probably, because the idea that you were going to punch around in stock markets wasn't quite the same as it is today.
No, no, quite. Hard to imagine, Thomas Jefferson get it using some insider information, with an enormous public spending bill to, get ahead of the
Well,
market.
there were no insider trading laws at the
Yep.
time. Okay, so the idea that you were going to address them specifically way back then, when I'm trying to recall when they were introduced. I'm pretty sure it's 20th century. I don't think they existed prior, but anyway. So
Yeah, yeah, cool. It's a very interesting topic. I'm sure it's one we'll return to, given the public's fascination with us,
yeah,
and indeed all the interesting stories you can get from it. Do get a bit more noise in the chat at the moment. Robert says, Butler and Shoshan, I wish you both and all your followers a happy, healthy, and wealthy new year.
thank you.
Thank you so much, Robert, and the same to you. Great to have you with us this evening. Get a question from Martin, who says, Hi, Boaz and John. The green agenda, bold and bright, from the government. Will this create a stilted market versus a one where any good idea can compete? How do we decide where to invest and where not in such an environment? Will the green agenda create a stilted market versus one where any good idea can compete? Good question. I would probably say I think the answer is yes. This is I think it will create a stilted market, but that's just me. I am very cynical, and perhaps John, you have a different view, though. I probably lean that you'd agree with me on that one.
Well, I mean, Buzz, you're up in Aberdeen, the fossil fuel capital
Yeah.
of Great Britain.
The
Um,
unofficial capital of Europe.
uh, Look, I mean, we've discussed this before multiple times, and my position is not that there's anything wrong with green tech. I mean, who wouldn't want to somehow generate more energy, produce more products, services, feed more children, whatever it is, using less energy, causing less pollution, less environmental degradation, toxicity, whatever it happens to be. I mean, it's kind of like people that wish for world peace. I mean, anyone who doesn't want it obviously has some kind of nefarious agenda,
Yeah,
right?
what's up with
Um,
that? Who would have
so,
done that?
so, I mean, come on. I mean, why wouldn't I want that? But history demonstrates that when governments throw a lot of money around, no matter how well intentioned, a lot of it simply fuels rent seeking corruption in various forms that never leads anywhere. And don't get me wrong, I mean, maybe 20% of it actually results in something good, but if 80% of it goes down the toilet, not good. And I'm very worried that the whole green agenda has so we're past the point, in my opinion, where um, there is strong transparency and accountability regarding where the subsidies are going, what they're being used for, how sustainable is this stuff really? And I've written multiple articles about how wind power has underdelivered, solar has underdelivered, various other forms of green renewable power have underdelivered, and those are the honest cases. There are cases where they haven't just underdelivered; there's been outright corruption and fraud, and that's what concerns me. History demonstrates that when governments throw money around like this, the outcomes tend to be suboptimal. And I think we're well past that point. I think there needs to be a reassessment. And I'm pleased to see some private non governmental organizations trying to get together now to form standards for evaluating ESG investment opportunities on more objective merits, which isn't just about whose palm you're greasing. That's a step in the right direction.
That's interesting, John. Because I've not heard about the private bodies trying to create a new set of
It's
standards.
like ratings agencies, right?
Yeah.
Like the ratings agencies
Yeah,
used to be before they got
totally right.
corrupted. Okay. No, but the idea is to come up with these standards which are not directly controlled by the governments awarding the contracts, but rather a more bottom up, initiative on the part of people that really understand ESG and and audit, properly audit the carbon trail or whatever trail or child labor, for in a cobalt mine, whatever it happens to be, and properly try to come around this and offer these hopefully reasonably objective standards to investors. If it can be done, great, and it's a huge step forward if so.
Yeah, it'll be interesting to see how that transpires. As I recall, John, one of your big shorts for 2022 is the ESG and the big green sector. So perhaps as what you describe unfolds, you'll see a knock-on effect of that when so many enterprises don't meet those kind of standards, and as a result, maybe get if they find it harder to fund themselves, etc. We do have a comment from David who says, I do enjoy most of your broadcast, Boaz and John, but as a Brit, I know I can't cope with so much relating to the US of A. I know we are tiny, but any chance of a UK version now and again, please. Apologies, David. I do hear you there, though. Of course, so much of what moves markets these days does originate in the USA. What with us using dollars for everything, but don't worry. In future, and indeed, we certainly can here. There's always a platform, of course, for UK-based questions in the chat. So if you do have questions specifically relating to things that investment news and market events in the UK that we're not covering, do feel free to ask them. And of course, we shall try in future to get some more UK focused content. I'm afraid I'm not going to. You're not going to be very happy with our next topic, which is not the USA. So maybe it won't be too bad for David. But this is actually regarding China and Africa. So it's an interesting headline. I think we can get it up. I think it was from the FT. That was regarding the Chinese Communist Party doing what they can to restrict credit on some of their African operations. So these are Chinese companies that are operating in Africa in resource extraction, things like that. And I thought this was an interesting story to dwell on this week, as I wonder if this will actually frame some of the economic development we actually see this year coming out of China and indeed from Africa. So we can go back to just go back to our regular screen here. But China applies Breakthrough Africa lending. John, what do you make of that story? Because I think it could be quite prominent as we go forward.
Well, what it does, right, is it gives you further context, or it helps you understand the context, because what you have going on in China, right? The Chinese economy has slowed down. It has slowed down a lot, right? The whole property speculation sector, which Evergrande is only a part of, but a big part of, it is slowing down. Steel demand in China, infrastructure demand, raw materials demand has come off a lot. And it's come off to the point where China's easing credit conditions, because obviously that's a huge part of their economy, because they are still a developing economy, notwithstanding certain sectors that have matured a great deal over the past couple of decades. And yes, China's made huge investments in Africa to try and secure various forms of mineral rights and, as you say, resource extraction generally. But look, if the domestic final demand is slowing down, then do you really want your state industries continuing to invest huge amounts to get stuff out of the ground in Africa and refine it and bring it home now? Or, might you want to slow it down a bit? It kind of fits together, and it makes sense that China understands that they have generated, again, it's in a way, it's a nice problem to have, but they've generated a bit of an investment bubble, boom, which needs to be, they hope, in a controlled way, gradually deflated back to a more sustainable rate. I'd be amazed if behind closed doors, the CCP hadn't long ago had that discussion that, guys, we've been running too hot, too long. We came out of lockdowns too hot. We got to temper things a bit. But by extension, what you're pouring into Africa has to be part of that. So I think that's a little more confirmation that China is trying to decelerate in a way that is at least the least disruptive possible to a more sustainable growth rate, given the obvious overinvestment in the property sector, both residential and commercial, exposed by Evergrande, but they're hardly the only example of this. They're just the most prominent. That's what I think this tells us. It's just more evidence of that.
Right. What do you think? What are the other signs you anticipate we might see in 2022 around that theme, around the China slowdown? And how much do you think we'll feel it over in Western investment markets?
Well, keep in mind, right? China is still a huge net exporter. I mean, they might need to import raw materials and energy. Absolutely, right? That's their whole economic model, is to import that stuff and then to export, pretty much everything nowadays to the rest of the world. And they've been doing very well at it. But the fact is, the rest of the world, which threw a lot of money around throughout the COVID lockdowns to try to keep some semblance of economic activity going, the rest of the world is also coming to the new reality, which is, oh, gee, we spent a lot of money, but we haven't actually spent it on industrial capacity or anything else that's sustainable. And we're going to have to rein things in too. We're going to have to raise taxes. We're going to have to slow spending increases down, so on and so forth. You've seen Biden's latest stimulus proposals pretty much die at this point. I'm not sure anything is going to get through, given that he's bizarrely kind of a midterm lame duck, which is odd for a president. That might be a bit of a mouthful, but if you lose Congress, you lose Congress, and you're never going to get any major legislation through again. Certainly not anything on the scale that he was previously pushing for. So that's the US. And then, of course, in the UK, the belt tightening is pretty obvious, right? I mean, tax is the highest in over 70 years, and there are a few other examples of this. So China's caught up in all of that, right? Their export markets are just not growing at the rate they were, and they've got this imbalance domestically, which they know they have, and they've had it for a long time, of being way, 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 for a huge country as big as China, to be that overweighted towards exports is unsustainable. They've always known that, but the question is timing. How do we wean ourselves off that model? And the blow up of Evergrande and the property sector, to some extent, is perhaps a catalyst to try and rebalance the economy more generally, gently, in a way that doesn't cause some severe recession, which causes political instability, which is the ultimate enemy, of course, of the CCP. Right? That's the last thing they want.
Yeah, that's what must be avoided at all costs, and I'm sure they'll find some way. Well, they'll manage to put it off.
Certainly, yeah.
Yeah. Well, actually, I think we're moving slightly sideways from here. We're trying, transitioning into the investment market, and we're looking globally, and we're looking at debt at the moment. So I find it very interesting that we're still getting these very, very strong inflation figures. I'm not surprised by that we're still getting those. And I think we're going to be due for a fair few more of those as we go through 2020.
Well, look, remember, Boaz, I mean, it was sort of baked in the cake, right? I mean, we had these discussions months ago.
We did.
That notwithstanding the very sharp uptick in CPI, which we anticipated, PPI, wholesale prices, if you will, were running even hotter. And of course, raw commodities prices hotter still. And the pipeline pressure was obviously there. And so the fact that you've now printed, CPI rates way above the Bank of England's expectations, way above the Fed's expectations. I mean, is anyone really surprised at this point? And yet here we are, right? I mean, the producer price and wholesale indices are still rising. Okay. Now, that said, the momentum of the rise is coming off, but that's a second derivative. There is still a lot of pipeline inflation out there. This is long from being done, this wave.
Yeah, and I think what a lot of people miss, or it may actually, I think in a way, the narrative was actually deliberately subverted, where you saw a lot of politicians and economists
transitory.
Saying, yeah, exactly, and not only is transitory, it's transitory because it's a supply chain issue, and supply chain issues, it'll just work itself out. All it needs is the market to move resources around. But what was deliberately not said is that inflation by itself will create its own supply chain bottlenecks. So, of course, it starts by saying, oh, well, we've got a lot of supply chain bottlenecks because of COVID, and that's creating this inflation. But what they're not saying is, oh, well, we're also creating a lot of inflation on the monetary side. And in the future, that will create further bottlenecks because all of the nodes in the supply chain will start acting to try and avoid it.
I mean, Milton Friedman, right? Milton Friedman is rolling over in his grave because he would have told you that if you throw money at supply chain bottlenecks, all you do is make what would have been a mild inflation problem a big inflation problem.
Yep.
So instead of inflation going to 2% or 3%, which is what they previously told us was the upper limit, now we're at 7%. And come on, I mean, it's basic maths in that case. Now, again, don't get me wrong. I'm not saying there's a mechanistic relationship between money supply growth and inflation. No. But when you get a negative supply shock and you throw money at it, then you're going to get inflation guaranteed.
Yeah.
And here we are.
Indeed. And so it's with that in mind that we've got these very high inflation rates. I find it interesting that the bond market just keeps giving up the goods. So this other headline I'd like to dwell on in this show is in the first week of 2022. We have seen $100 billion in new corporate debt issuance. Again, this is from the Financial Times. Companies raised $100 billion on the global debt market in a brisk start to 2022. So I find it interesting that interest rates in the corporate bond market are not really high. So the companies that are borrowing are still borrowing very cheaply, and the investors that are ponying up the goods are not charging a high interest rate, despite the fact that inflation is running so high. So it's almost as though the debt market doesn't realize just yet, or it doesn't think that inflation will continue the way that it has. Maybe it still believes the transitory idea. And maybe in a way, the corporations doing this do know that this is what's going on, and they're just trying to borrow as much money as possible so they can spend it now, and then they pay back less after inflation has destroyed some of the debt. John, what do you make of that?
Well, look, I worked for many years on the so-called sell side of the financial industry. But the sell side, what does it sell? It sells, in many cases, the debt that it originates from corporations. And there is a traditional sell side pattern with respect to corporations, and it does follow the interest rate cycle. And when interest rates are falling, well, of course, you go to your corporate clients and you say, hey, interest rates are low. You should issue some debt and take advantage of this. But the conversation, of course, is difficult if the trend has been in place, and some people say it's going to remain in place. How much can you get corporates to issue right then and there if they think rates will get even lower? So, of course, eventually rates get a bit lower, say, and then you reach the bottom of the cycle, which some people might try to time fairly precisely, saying, okay, this is it. You should issue your big bond now and get your refinancing done, for whichever product, whatever it is. And fine, you might convince a few people, but when you really have the conversation with your corporate clients, when you get into that boardroom with the CFO, treasurer, whoever else is on the finance committee, and you say, guys, look, interest rates are going up. This is your last chance. This is your last chance to get that bond out the door before you're demonstrably going to be paying more and your shareholders are going to punish you for taking too long to make this decision. The time is now. The hard sell, as it were, from the sell side happens when it appears, at least, that you've reached the bottom in a major interest rate cycle. And it's perfectly normal for your typical corporate CFO, treasurer, finance committee to do a bit of, cover your, bond issuance to look good when it appears it might be a major cyclical turn, whether you need the money or not. Just, hey, look at that. We issued that bond right round the bottom in rates. We're heroes. You can thank us shareholders. And yes, we'll take bigger bonuses this year as a result. Of course, the previous bad timings you might have done, the first, the last 2-3 issues, everyone's forgotten those. But, you're a hero now that you got this one right. I've seen this mentality play out through a couple cycles in my career, big time. And this may be more of the same.
Well, a big shout out then to those CFOs who made the right decision, eh, John?
Look, don't get me wrong. There's nothing wrong with trying to time the market if you think you can time the market, but most corporate finance officers probably should be doing other things with their time and just issuing debt when it's truly necessary to do so, as opposed to trying to look like heroes. Whatever.
Yeah, sounds like sage advice, though. I'm not sure they'll listen. On a similar note, regarding the inflation side to it, John, how do you think that's going to play out as we go further through the year? Because what happens after that? So once it does look like, okay, interest rates are bottomed and rates are rising, how do these CFOs then behave later on when they still need to issue more debt?
Well, look, if you take a look at aggregate numbers and you can look at pretty much any major country, right? Major, the UK, the US, Japan, continental Europe, the amount of debt on the balance sheet is high in a historical comparison. And you can argue, I mean, some people would argue that makes perfect sense. Everyone's taking advantage of low interest rates. So, of course, they have a lot of debt on the balance sheet.
Yeah.
But what that means, of course, as interest rates begin to rise, that the need to borrow more, unless you're a distressed company that's borrowed short or is hugely leveraged, the need to borrow more is not going to be high. And you're going to absorb that rise in interest rates as best you can with what hopefully is a relatively long-term debt profile that you've already issued. And then you take advantage of what remains an effective low borrowing cost for a couple more years, maybe longer. And that's what I think is going to happen. A lot of corporations are carrying a lot of debt. Now, in some cases, it's funded share buybacks, and you could say, "Oh, gee, that leverages up the firm." It does, and it doesn't. If you don't pay much of a dividend, then you're not under a whole lot of pressure to pay out a hell of a lot more. And as long as your revenues rise with inflation and your debt servicing costs remain relatively fixed because you've got some long-term debt on the balance sheet, you're not going to be in any immediate distress. So yeah, you can argue both sides of it here, but the point I'm trying to make is that the idea that somehow higher interest rates are going to hit corporations hard, that will only be the case for corporations that made bad decisions, right? Not only leveraging up, but leveraging up and swapping long-term debt into short-term debt, leaving them directly exposed to higher short-term rates. And corporations that have done that are going to be in very serious trouble in a year's time. I mean, even if inflation remains high, such that real interest rates are still negative, look, it doesn't matter if real interest rates are negative. If your nominal cost of debt soars and you're not able to increase prices fast enough with consumers in your specific market, you're in very serious trouble. But I think that will be a subset. I think the corporate sector generally is actually kind of ready for this.
That's interesting. Moving away from the corporate sector, when you're saying the ones that make the mistake are the ones who had the long-term debt and they swapped it out for short-term debt. I mean, of course, there are different rules for countries than there are for corporations. That's effectively what the US did with Mnuchin as Treasury Secretary. I mean, the US had all this long-term debt, and he was very happy swapping all that out for really short-term stuff. How do you think that affects the US then? And of
Oh, the
course, I
US
mean,
is way more exposed now. See, this is the thing, right?
yeah,
And many people have made this comment that if you compare the United States today to the United States back in the Volcker years, not only was the national debt considerably smaller as a percentage of national income back in Volcker's time, but the duration, the average maturity of the debt was longer back then.
yeah,
So what Volcker did, while yes, of course, it increased interest expense for the government, it did so in a way that was disproportionately small compared to what you would see today. Today, it would be disproportionately larger. Oddly enough, or not oddly enough, the UK, don't get me wrong, the UK has done lots of irresponsible things with its finances through the decades,
oh, don't worry, I
right?
believe me.
But
Yeah.
it currently has the longest duration debt of any major government. And look, I mean, look, you got to give credit where it's due. I think it's terrific they've done that. I'm not. There are reasons why, which have to do with the structure of the UK insurance and pension industry, which is really captive to holding UK government securities, and
Yep.
they really need and want long maturity securities to
Yep.
match their liabilities. And you could say that's all an accident, and yet bizarrely, or not bizarrely, maybe there is some grand plan to it all. It does help protect the UK government from the Bank of England raising interest rates. That said, it helps the government up to a point. And that point is the extent to which the Bank of England raising interest rates doesn't hit the financial industry hard, banks, insurance companies, and whatnot, that still have big short term interest rate exposure because the financial side, the stock market in the UK, right, the market cap of financials and the contribution of financials to national income and tax
Yeah.
is disproportionately large amongst developed economies. And of
Hmm.
course, that sector is the sector that, other factors equal, gets hit hardest when you get into a really aggressive interest rate hiking cycle. And indeed, it can lead to an outright financial crisis, as we've seen before. So it's going to be interesting to see that one play out, because if the financial sector becomes distressed again, guess who's going to have to throw money at it to bail it out? The government. And so the government that was somewhat insulated from higher interest rates ends up being directly exposed when they have to open the checkbook.
Yeah, where the way it works in this country, when you have so much of the financial services sector, well, the financial services sector is so large and it contributes so much to our total economy. Having a big interest in the longer term dated debt, and then inside the country, the average mortgage maturity in terms of fixed term rate, most of them are 2 to 3 years, if memory serves, which makes just the residential real estate market really sensitive to interest rate rises. It's very interesting how you have there's this big balancing act, I guess, ultimately between long term debt interests in the city of London, effectively, which dominates so much of our economy, and then you've got the everyman all the way through the UK, which is very very sensitive to interest rate rises. I remember someday, I forget, one of these big bond guys who was saying that the UK resembles, in a lot of ways, an emerging market, in that interest rate hikes become very recessionary quite early, because so many people have mortgages that are only 2 to 3 years in duration on a fixed rate before they have to refinance at these higher rates, and this makes things. It can make things really difficult if the Bank of England needs to start hiking these rates. I mean, do you think? You were saying how in the City of London you've got these insurance and pension institutions that really like longer term dated debt, and it's in the government's best interests in a lot of ways that they get that, and it's sort of a happy coincidence that the Treasury is very eagerly hands out long dated gilts, ultra long dated gilts, and the like. And of course, we did once upon a time used to have the perpetual bonds, the infinite bonds that I
Consoles,
think,
yeah,
yeah,
yeah.
yeah, the consoles featured in Jane Austen novels of old, which I think George Osborne retired in 2013 and 14, the last ones of those. Do you think we're going to see a move back to things like consoles in the future if the government
Well,
does like that kind of financing, and the City of London likes that kind of financing too?
I mean, currently there's not really a market for perpetual debt. You do have some very long-term debt issues, I believe, out to a century, that were made by a handful of countries over the past decade or so. I think Austria might have issued a century bond.
Yeah,
Um,
Argentina too. Yeah.
but I think that's a bit of a historical aberration. I mean, keep in mind, right, when the consoles were issued, the UK was on the gold standard. And so you were issuing something which was linked to gold, and the money was stable and couldn't be just printed willy-nilly. And the difference between a perpetual debt and a shorter dated debt, when the money is stable and there's no credit risk and it's just time value of money, um, there's actually less of a difference. Whereas today, when you have no idea what the money supply will or will not be, 5, 10, 20 years from now, what the interest rate will be in the market vis-a-vis whatever fixed rate, um, it's really not, it doesn't line up. It becomes a big mismatch, and I don't think that it's realistic that we would move back to perpetual debt absent a return to a more stable monetary system, a la the classical gold standard. And of course, there's no political interest in doing that currently. So I think we're kind of stuck with what we have for now. And again, it makes the government's position look relatively safe vis-a-vis the Bank of England getting some religion and raising interest rates to try and get inflation under control. But that only works until it doesn't cause some amount of financial distress, which presumably the government, a la 2008, 2009, will once again step in to rescue. And that's an expensive thing to do. I mean, they always say it's not. They say, oh, it's just a guarantee. The taxpayer isn't really on the hook. Look, we know that's not true. The taxpayer is. Eventually, it does come out. It tends to come out through inflation rather than upfront tax bills. Although that said, depending on the circumstances, that could change. But it is the taxpayer that pays that bill. Those guarantees do cost money, and the chickens do come home to roost, as it were.
Indeed. I suppose any budding Jane Austens out there will need to give their bachelor heroes a different source of funding for their fortunes rather than the traditional console in future. But I'm sure there's all manner of ways which they, well, I imagine young crypto billionaires could probably feature in a modern reinterpretation of something like Pride and Prejudice, perhaps. Now, one thing you did say, John, was how during an inflationary environment, it kind of separates the wheat from the chaff between corporations that have done good things with their money, who've planned well, planned prudently, and those which have not. This does bring us very nicely, I think, into our long short section as we are getting into the closing section of this South Bank Live. What is your long and your short for this week? And for everybody who is watching this, who is new to the show, this is where we take a couple of topics. They don't need to be investment assets. These can simply be behaviors or phenomena that we are feeling bullish or bearish on. And this is what we put in our long short segment. So just to start us off with, John, what are you long this week?
Well, I try to get as practical as I can, Buzz. And one thing I notice is that if you take a look back at the charts, going back to the very, very beginning of the COVID scare back in late 2019, and you follow through to today, you see that initial big sell-off that occurs in early 2020. And then you see this long recovery that happens thereafter. But the recovery has been disproportionate. And this is where it gets interesting, because it does seem to me, and I'm certainly not alone in this judgment, that disruption, including some of the supply bottlenecks, is beginning to work itself out, right? It's not just that life is beginning to return to normal. It's also that some of the disruptions are beginning to work themselves out also. We're seeing some signs of that. And this is what's interesting, is that you take a look at the broad stock market, and you see some things that I don't think make sense now, given again that we've come through this, or we should be looking through it, right? Stock markets are always forward looking. Okay. Some things don't make sense. First of all, the US outperformed massively. The US stock market was already expensive in valuation ratio terms vis-a-vis most of the rest of the world going into COVID. It's even more expensive now. That does not make sense to me. I don't see why somehow COVID makes the US a fundamentally better place to do business, especially when you look at the overall increase in the tax burden, and the overall increase in the size of government in the US, which has been very, very high. Don't get me wrong, it's risen in most places, but in the US it's risen disproportionately more. And that doesn't make sense to me. So why is that? Well, the reason why is, again, look within the stock market and you see why. It's big tech. It's really driven by big tech. It is only in the last 6 to 8 months or so that other sectors have begun to catch up to that expensiveness. And they're lagging behind. So not only is the US way too expensive, US big tech is way too expensive. It has left the whole rest of the world behind. And I just don't think that's sustainable. I think it's an artifact of people thinking that we're all going to be living and working from home forever, more dependent on tech than we ever were. No. The world is normalizing in some way. So I think US big tech I've mentioned this before. I think it's the most obvious short. And there's a company starting with a T, which is the one I pick on more than the rest of them, because it's a big tech firm that also pretends to be a car manufacturer, and it's not even really a tech firm. I hate to say this, but the tech isn't that cutting edge. It's almost borrowed from other sources. It's more a brand image and hype company that begins with a T and it's 5 letters. Okay, so that's the best short I can think of. Okay, now what do you go long against? And this is the interesting one. You actually go along the real manufacturers. You go along the basic industries. Get this: the Nikkei and the FTSE are disproportionately higher in basic industries than the US is, because they don't have much big tech in terms of their market cap. And so, the FTSE has, Rio Tinto and BHP and some of these traditional miners, and, you've got other basic industrials. And in Japan, of course, you've got your industrial conglomerates. Get this. I mean, the US S&P and Dow indices, I mean, the S&P has done done better because it includes the big tech more than the Dow does. Dow being more traditional industrials, but between the two of them, they're up 25 to whatever it's 45% over the past 2 years. The FTSE unchanged, unchanged. The
Yeah.
Nikkei up less than 20%. That to me, again, it makes no sense. And so you want to be long basic industrials, number one. And if you want to get that exposure, get it through your FTSE basic industrials and get it through your Nikkei basic industrials. And don't get me wrong, I mean, the US industrial basic industrials have actually been doing well. John Deere's up over 100% over the past 2 years, right? Caterpillar is up about 50% over the past 2 years. Well done, guys. But
Yeah.
I think some of that is just a general dragging up of the US market. And so I'm relatively worried about them vis-a-vis their counterparts in Japan, the UK, and probably Germany as another source of quality basic manufacturing and industrial stocks.
Yeah, on the topic of Germany, it is interesting that their lack of having a Silicon Valley, Wirecard was like their best tech
Oh,
company, and of course it
yeah.
was a total fraud. And that was generally seen as sort of this is a failing on the part of the European industry that they've not been able to generate any of these, these unicorns that we keep hearing about, which then turn into world dominating tech companies. And yet in this environment, perhaps not having these big tech firms will actually be seen as a really valuable thing to have when it comes to stock market performance. So we'll be very interested to see how that turns out this year. As I say, inflation is something that the market has not been used to for a long time. Where I've not been used to it. I wasn't even
Well,
born at a time when there was much inflation.
I mean, look, where does final demand come from? Final demand comes from consumers, okay? And while a certain portion of that is chasing after luxury goods, the vast majority of it is after food, clothing, and shelter. Okay. Now, look, if you get into a highly inflationary environment where the cost of food, clothing, and shelter is rising faster than your own income, what is it you really want? You want companies to find more efficient ways of getting food on the table, of getting a roof over your head, and getting a shirt on your back. Those are not tech industries. They're just not. Inflation is not good for tech. Now, the
No.
tech sector was way smaller in the 70s and early 80s when we went through the big stagflation, way smaller. But you had Texas Instruments, Hewlett Packard, IBM, right? You had some major tech companies, and they had an awful time
Yeah.
because people just weren't interested in that sector given the exigencies of dealing with the food, clothing, and shelter inflation problem, which is exactly where we are now. And we're going to remain in this sort of environment for at least a year or two more. And big tech is going into this so overvalued, it's obscene. Again, there are some firms that are more overvalued than others. But that's to me, it's a historic opportunity to be short something and just be defensively, as it were, in basic industrials, and you'll at least retain your purchasing power, if not, maybe even benefit a little bit along the way.
Well, very interesting observations, John, as ever, indeed. Of course, we cannot give personal financial advice in Southbank Live. This is for informational and entertainment purposes, hopefully, only. Though I must say, yeah, it does look pretty good for the UK in this kind of environment from an investment angle, at
It's
least.
all relative. It's all relative, Buzz. The FTSE simply looks good value here in
Yeah.
relative terms to the United States following this 2 year period of colossal outperformance by the US, led by big tech, but affecting other sectors in the US too. The FTSE's really been left behind. Looks much better value here.
Well, hopefully, David in the chat will be very pleased to hear us
Yes.
dismiss the US in favor of the UK on this topic. We have had a couple more questions. One is from Jason asking, are UK politicians' investments measured? I believe this is referring to whether or not their investments are publicly disclosed in the same manner as they are in the States. I believe this to be true, though I think it's in a slightly different manner. John, are you familiar with the ins and outs of that?
I'm only aware in general terms that if you're a sitting MP, you must disclose your personal investments. Um, That said, to what extent you're allowed to do things that might be seen as dodgy, insider, this, that, when you're involved in evaluating a contract to be awarded for PPE equipment or whatever might have been abused over the past couple of years, I don't know the details. All I know is that you do need to make disclosures of your investment portfolio. But
Right. Yeah.
again, sitting members of Congress have to also. They're just not forbidden from actively trading it as long as they disclose it. I don't know precisely how it works in the UK, but the disclosure is definitely there.
Yeah, one does wonder whether or not some MPs sitting on the right committees or public health officials, knowing that lockdowns were about to be eased, perhaps would be allowed to dabble in the pub stocks and make a fortune over the past couple of years. On the subject of which, I think I'll start. My short for this week
Ah, yes.
is bringing your own booze, and my long as a result is going to the pub. I think that's my pair for the week.
Eggnog. What, you're gonna bring your own eggnog, seeing as how
Yeah.
that was your long going into Christmas or something.
Yeah, quite. I don't think bringing your own booze is going to be seen too well in the coming weeks, but who knows? Who knows? And we do have one last question on the topic of gold, which I think we're getting quite on for time, so I think we'll have to save it for next time. But Aidan, we shall of course continue discussing gold. This is an argument he's making regarding gold trumping crypto due to its prominence within the central banking system. But Aidan, thank you for your comment. We shall return to this in a future episode. And thank you for all of you who have tuned in this evening, and for those who are watching a recording of this. It has been great to get back to South Bank Live in 2022, and we shall continue. So thanks to all who tuned in. Do give us a subscribe and a like if you do enjoy it, and post any comments below this video with questions or themes that you'd like us to dwell on in future episodes. That's all for this evening. John, thank you so much for joining me.
My pleasure as always.
There you go, folks. Hope you have a very nice evening, and we'll see you next week. Bye-bye for now.